All right, fantastic. Good morning, everybody. It's December 21st, 2010. This is a co-production between FXDD and FXStreet.com. Very glad to have everyone here this morning. Our disclaimer is we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, so as mentioned in the pre-show, this is really exciting. We've got a new one for you today, Trendlines and how to use them effectively. This is an often overlooked topic that we really are going to enjoy talking about. I think everyone's going to take great benefit from this as well. Okay, so I'm Sean Powell. I'm there on the left. I'll be hanging out with Greg, helping him along in the chat window. Greg Michalowski, the man you've come to see, is our FXDD Vice President. He's also the Chief Currency Analyst at the company, and it's really a pleasure to have him on the training with us today. You're going to learn a lot. Now let's talk about a couple different going feet. What this means is, and it's revolutionary, it means that you can take profits made in a demo account and turn them into real profits in your trading account. You can get all of the details for that at FXDD.com. Go in and look at that promotion. It's something pretty interesting and unique. Okay, so if you want to get more on Greg, here's what you can do. Greg is also a blogger on FXStreet.com. His blog address.
All right, thank you, Sean. I really appreciate it. I assume everyone can hear me well enough, and hopefully you'll be able to see my PowerPoint screen as well. We are going to talk about trend lines, effectively setting them. And what I like to tell people is that there's no barrier to ways that you can try to make money in the foreign exchange market. That is, if there are some low-hanging fruit out there, some clues out there that will allow you to do two things. One is to determine bullish and bearish bias. That's so important to determine if the market is bullish or it's bearish. The second thing that you need to do in all your trades is to be able to define risk. And if there are tools out there like a trend line that allow you to determine bullish and bearish bias and also to define your risk, I'm going to use it. I'm not going to be proud and say that, oh well, trend lines are not sophisticated, not advanced. No, my goal and my mission in trading is to make the most amount of money with the least amount of risk. And if you can determine bullish and bearish bias and determine what your risk is on a trade and allow yourself to limit your risk while it have the potential for a trendish type move or a breakout type move by utilizing a tool like a trend line, I'm going to use that tool. I'm not going to put my ego ahead of it and say things like, oh well, it's not sophisticated enough. So this is one of the three tools that I use in my trading. I use trend lines, I use moving averages, and I use Fibonacci retracements. And all three of those tools, folks, are able to tell me a bullish or bearish bias and also define my risk. And they also potentially lead to trend type moves. And trends are where you make the most money in trading foreign exchange. Trends are indeed your friend. Trends are fast. Trends are directional. And if you can catch a trend, that's where you're going to make the most money. If you trade against a trend, that's also where you're going to lose the most money, folks. And that's why they're so important. That's why things like trend lines are so important. So what is a trend line? And a trend line, to myself, is defined as a line drawn on a chart that typically connects bar lows to higher bar lows when the market is in an uptrend. That is, it's a bullish trend line. And also there are bar highs to lower bar highs when in a downtrend, a bearish trend line. So most people think of a trend line as being upward sloping or downward sloping. An upward sloping trend line connects a low with a higher low. It seems kind of awkward, but when you see the picture, obviously it makes sense. You connect a low to a higher low. That determines a bullish trend line. Then for a downward trend line, what you want to do is connect a high to a lower high, and that makes a downward trend line, and that's called a bearish trend line. A line can also be drawn that connects lows to lower lows or highs to higher highs. These trend lines are used to create things like channels, a bull flag, a bear flag. These are just some examples of how connecting a low to a lower low or a high to a higher high, make a chart pattern that's a trend line as well. I consider that trend lines, and they give you clues as far as market direction. They also define your risk, the two requirements for all our trades. A trend line can also be drawn for things like pennants or wedges, and we'll probably go through a few of those examples here. Those are the main trend lines that I look at. I also have a specific trend line, specific trend line that I call a remembered line. And the reason why I call them remembered lines is because I believe that the market remembers certain prices. It could be in the middle of a non-trending period. It could be connecting highs to highs or lows to lows. Those typically are those highs to highs and lows to lows. Typically, people envision a ceiling or a floor. But what happens when the market uses a price as a floor level, and then the market breaks through that floor, and the market comes back and uses that floor as a ceiling? That's in the middle of a range type trading. And in those instances, those are prices that I consider to be remembered by the market. So I call them, to make things simple, remembered lines. And remembered lines are a jargon that I use in my analysis. If you go to my blog at forex.fxdd.com, you'll hear about things called remembered lines. And remembered lines are just like trend lines in that they determine a bullish or bearish bias. They also can be used to define your risk. Two of the most important things that all traders need on every single trade that you do. So again, remembered lines, and we'll talk about them in just a second as well when we get to our charts. The most important thing, and something that I've already reiterated in my introduction here, is trend lines are what I call border lines that give a bullish bias if the price is above the trend line, and a bearish bias if the price is below the trend line. So if you have an upward slope, imagine in your mind an upward sloping trend line. If the price is above that trend line, guess what the bias is? Bullish. If the price goes below the trend line, guess what the bias is? Bearish. And that defines, by defining a bullish and bearish bias at a trend line, it also defines your risk just by definition. Why? Because if the price goes below a trend line, it turns the bias from bullish to bearish. Guess where the risk is? If the price moves back above the trend line. So you're able to define your risk and keep that risk to a minimum. And if we go back to my mission statement, what is the mission statement of all traders? To make the most amount of money with the least amount of risk. So if you can define your risk, and your risk can be a very small amount. I want to take your thumb and take your index finger and put them close together. That defines a small amount of risk. Now put that against your chart. Any trend line that you have, you can define your risk as being a small amount of risk. And if you can define your risk to be a small amount of risk, you're accomplishing one side of the mission statement with the least amount of risk. Doesn't mean that you're not taking risks, just saying you're taking the least amount of risk. Making the most amount of money is what we hope a break of a trend line or a bounce off a trend line will do. If the market bounces off a trend line, you should see a move to the upside or to the downside, depending upon where you're coming from. If you see a break through a trend line, you should see a momentum move through that trend line. That's going to lead to a multiple of the risk that you're going to be taking on that trade. It's pretty simple, but it's very effective if you know what you're doing and you know how to effectively set the trend lines and then use them to your advantage. So, with that introduction, I'm going to take the screen off of my PowerPoint, and we're going to start to get into some of the charts here and look at using trend lines as a tool for your trading. So I look at three different charts. I look at a daily chart, I look at an hourly chart, I look at a 5-minute chart, and I look at them for all the same reasons. There we go. Okay, we're on our chart. So I look at a daily chart. This is daily chart of the euro. You can see it up here in the corner, right here. It says daily. This is the hourly chart of the euro versus U.S. dollar. and this is the 5-minute chart of the euro versus US dollar as well. And clearly, well, not clearly, but you see a lot of different lines across my charts, a lot of different trend lines that I've drawn in, and I'm constantly looking for clues from the market that will allow me to draw a trend line. And why do you think that's important, or why do you think I'm looking at it? Besides the fact that they help define the risk, they also tell me bullish or bearish bias. And I can ask you that question, but I'm not going to allow you to answer it. But the reason, one of the reasons is why I think trend lines are so important, especially when it has to do with the foreign exchange market, is this. The foreign exchange market is a collection of thousands and thousands of traders from around the world. And thankfully, because of transparency, the traders at the banks or at the hedge funds, at the institutions out there that in the past had an advantage over retail traders are now looking at the same chart as you and I are looking at. Our retail traders are people we're in the same market with the same transparent price with the same charts. So if you have a collection of thousands and thousands of people looking at this same euro-dollar hourly chart, I want to put those lines in that not only make sense to me, but make sense to the masses, that make sense to every Tom and Peter and Mary and Harley and Pink Lotus and Robin B. out there in the world who are looking at foreign exchange charts to determine clues and opportunities to trade the market in an effective manner. And so the more people can see and visualize a thing like a trend line, the better chance you have that this trend line is actually going to work. It's kind of a self-fulfilling prophecy. So that is another reason why I think trend lines are so important. So whenever I come in and look at a chart like this hourly chart on a daily or hourly chart, I will always look to draw lines in, and I'll draw lines that connect highs to highs, like this line right here. We had a high here, a lower high here. We broke through that trend line. We moved to the upside. I'll sometimes keep that line in there. Why? Because the market held this level, and then what did it do? It came down toward the bottom. And I'll also look to do put in what I call parallel trend lines that will show a channel, because the forex market likes to trade in channels. They like to find those borderline levels that are levels where you could where you can trade against, where you can take profit, where you can look for low risk trading opportunities 24 hours a day. Give me 1 second here. I had part of my granola bar I was revisiting. So I will look to put in this any trend lines that I possibly can that will help define my risk. And so you can see here on this part of the day, the market, or this part of the chart, the market went above this level. But I could connect these highs right here, and I can see that 1, 2, despite the fact that the market broke above the trend line, we had a nice, if you ignore this part, and I don't mind ignoring a break that comes back down, especially in a volatile markets like we're experiencing now, or a liquid markets, holiday type markets where the market's going to go up or down. But I'll look for some sort of pattern that will exist that everyone can see. And then I can put this top trend line, and I'll put a parallel trend line along the bottom. And I can see that, well, it connects this low with this low with this low, and lo and behold, yesterday we go down to that low as well. So does this level have a level? Is this channel of significance? I think so. Is a channel that some people can, not only myself can see, but others can see? I think so. I mean, I think it looks pretty good. And then I'll come in and I'll also notice that, okay, what do we have here? We have the market moving up off of that lows, and I can connect lows as well here. And final thing that I can do is I can put in a horizontal line here against what would be, people might say, is the ceiling for this currency pair. I like to term it a horizontal trend line. This is what I term a remembered line. Why? Because the market remembered this low, it remembered this low, it remembered this low, and when it remembered this low, it fell through this low and caused the market to move to the downside. And then when it came back up, we remembered the lows, the floor became now the ceiling. So that's an example of what I term a remembered line, and I'll constantly draw those in the charts, and I'll define these key levels for the market. So, going at this, or looking at this chart, and when the market comes up to this level right here, at this point, around the 131.85 level, notice I also have another horizontal line coming in. Why? Because this level corresponds with this low right here. And if you go back in time, it corresponds with that low right there. And it corresponds with that low right there. And we broke through this level and failed. It went up, and we correspond with that low right there. You see how these two parallel lines come into play at a number of different times. It corresponded with that low right there. It corresponded with that high right there. It corresponded with that low right there. Is this level an important level, folks? Is this a level that the market remembers? Of course it is, So, so when the market comes up to this level right here, where I find this trend line, I find this parallel. I've defined this parallel trend line, and the market comes up to the 85 level. Do I know there's resistance at the level? Yes. Can I define my risk? Yes. My risk is if the market were to go up, maybe a half a box right here, a half a grid of risk on this trade. And what is that is my risk. My risk may be as little as 10 or 12 pips on this trade, maybe even less. If the market breaks the trend line, it's getting above the 85 level, this top of this remembered area, and it also is above the trend line. So that tells me that I can define my risk. I can also, take a shot that the market is going to find resistance against that level, and if the market proves, or if that level holds, guess what? The market is going to wander to the downside like it did. All I have to do is get through this floor right here. If I get through the floor, then I'm working down to the next level of support. So you start to, if you're trading if you're trading by using things like trend lines or remembered lines, and you can combine a couple of them into one, and find these levels become what I consider low-hanging fruit. They're very low-risk trades, folks, with the potential to earn a multiple of the move. You may have to wait for this action to take place, but there isn't any fear in a trade against this level right here. Your fear is if you can decide that this risk is something I can accept, this risk between here and here. And for those people out there who are listening, I'm sure there are plenty of people who will risk this amount on any trade at times. In fact, probably daily. And if you can instead risk this amount instead of that amount, you have the better potential to get a multiple of your risk to the downside, or on the trade, in this case to the downside, than you do if you were risk something like this amount and hope for a move that's going to be a multiple of this range. And that's the essence of trading successfully and having your account grow, is being able to take these low-hanging fruit opportunities where you have trend line resistance, not only just on one basis, but on another basis. So this is a perfect opportunity and a perfect example of how you can use a trend line and a remembered line in combination and profit from the trade. So the market goes down, we make a new low. What does that low come in against? Well, if you go to the daily chart, you can also see that the 200-day moving average, that's a green line in this chart, comes in around the 130.97 level. What was the low on the trade here? 130.94. So do you think we had support against that level? Yes. But that's using another tool that we use, and we're not necessarily going to want to talk about that here today, but certainly off the daily chart, what you can see was there was good reason to find that there was support against the 200-day moving average yesterday and today, and that's why the market did find support at that level and move back off of that level. Now, as we go forward, we of course have another opportunity here, and that opportunity arises. Why? Because we draw a remembered line here. We draw a remembered line across at the 130, 130 level, or 29 level, give or take a pip or two. And when the market has 1, 2, 3, 4, 5, 6, 7, 8, in 9 or so hours, where the market trades is not able to trade above that 130, 130 level. And notice here that the market price is going up on a nice little trend to the upside, but the spring is coiling, folks. You can see that the market's got to do something. Either it's going to go, is that a low-hanging fruit opportunity where you can define, go short here, thinking that the market is going to, anticipate the market, and have them higher. But that's what good traders do. They make their own luck. They look for the break. Perhaps they may get in on the trade at this level, 130, 138 or something like that, with a risk below the 29 level or 30 level, risk 8, 10 pips on the trade. Will you risk 8 or 10 pips? I would. For a possibility of a move that's going to take you to the upside, and potentially through the upper trend line. So once this spring is coiled here, once the market is in this tight situation where it has to go somewhere, because why? Because the market has to move. It doesn't stay still. Even in these non-trending days coming up to Christmas, you need something a little bit more than about a 20 pip trading range for the day. It's just not going to happen. It's going to extend somewhere. So this spring starts to coil against 2 trend lines, and it's ready to explode. It's ready to move, and then we get the move to the upside. The market gaps flies through the trend line, resistance through the remembered line, and the next stop is to get through this old trend line, which we held here, and we get through that level. The next stop takes us up to our 85 level. And also the 38.2% retracement of this move to the downside comes in at 131.95 level. So we have a lot of reasons why the market should pause at this level. It comes off, it breaks back up to the upside, and then moves back down to the downside. And where do we come down to? Our old trend line. Why does it stop at that trend line? Well, because it's now this trend line right here, and guess what it was? It used to be as well. It used to be a floor here, it used to be a ceiling here, and now it's a floor here. So now we've added 3 things, 3 reasons why this becomes an important level, a level where traders can trade against. I'll zoom in here. Levels can trade against. This comes in at 32. This line's at 29. It's 3 pips wide. And then the market starts to move higher here. And where do we go? We go right up to our resistance level again, around the 85 level, against the 95 level, the 38.2% retracement. And what does the market do? It tires and it comes back down. Where do we stop? Initially, we stop it against the trend line here. And then what do? We break through the trend line, and what do? We go through the 30 level. Now we're kind of, how many times can you test the same line? A number of times. It's getting tired. The market's getting fed up with these lines here, and that typically happens as well. Is that after you come to a remembered line 1 time, 2 times, 3 times, 4, 5, 6, 7, 8, 9, break through that 10. It gets tired. It just says, okay, I've had enough. The other characteristic of remembered lines, folks, are what helps define a remembered line is, think of it in terms of looking at this chart and saying, how many times do you think that 130, 130 level traded in relation to any other price in this narrow trading range? In my mind, it traded very little. We never got to the level here. We went a little bit below it here. We just touched it here. We never traded it here. When the market moved through the level here, it probably went through quickly. When we came back up to the level, we didn't trade it. We didn't trade it. We didn't trade it. When we moved through, it didn't trade. We came down here, it didn't trade. It doesn't trade at all. So a remembered line is actually a line that the market or a price that the market is likely didn't trade a lot at. So that's another characteristic of a remembered line. And eventually, what happens is that the market says that instead of being a level where the market reflects or deflects either to the upside or to the downside, what the remembered line ends up becoming is a level where the market may even settle. It might even trade at that level, up and down, for the time being. Why? Because the market is just so tired of this up and down motion. And you can see that in the 5-minute chart here today. Zoom to the upside, come back to the downside, non-trend, zoom to the upside, come back to the downside, non-trend. we're in this pattern. We have this. The market eventually will get tired, and we are heading into the London. We're in the last hour of London trading, and a couple of days away from Christmas. So I wouldn't be surprised if the market just kind of dies down from here on in. So there's an example of the euro versus U.S. dollar. Does this work in other currency pairs? You betcha. And on other charts, you can use it. Well, look at the sterling versus U.S. dollar. In this section up here, we were able to define a channel. It's a wide channel, but the market these tops develop a nice ceiling here, and you can see we develop a top here, we develop a top here, we develop a top here, and I'll eyeball it and just say, oh well, I'll put a line in there, and then the market develops a bottom at this point. And actually, if you extend this line, to that level right there, it's very similar to what we saw here. Maybe it broke through the bottom trend line a little bit, but you define a bottom here, and then if you get a move back to the upside, what are you anticipating? You're anticipating resistance, especially after a sharp move to the upside against these old highs right here. And what do? We get it, so that has a nice move to the downside. We get another move to the upside. Is this a level where you can anticipate, where you can sell the market at that point? Sure, why not? What's your risk? That amount, folks, that amount. Is that a small amount of risk that you should take? Why not? The market moves down. What do? We come back up again. Now we have 1, 2, 3. This is a small test. I mean, we didn't get to the line, but that's close enough. We get another test up here. You could be selling at this point. What's your risk? The market moves above that line. What happens? The market comes back down again. And where do we go? We go down to the bottom trend line. This parallel trend line off this high. This high is certainly established. And where do we come down? We come right down to this trend line right here. So is that a good level to buy? Yeah, why not? And the market, what does it do? It goes back up to the top. And what do? We break through that level. And what does it do? It fails. It fails at the top. This is an example of, for those people who say, oh, well, what happens if I get whipped around? Well, you get whipped around, but it also tells you some clues about the market. It tells you, we're running out of momentum here. The market cannot develop any momentum above the trend line. If the market breaks the trend line, what do you expect? You expect a momentum move. You expect a movement to the upside. What happens if it doesn't do what it should do? You get out of that trade. They're not all winners, folks. You get out of that trade. Maybe you even sell the market here. And what happens? The market goes down, and what do we do again? We get 1, 2, 3 different points where the market goes above. Do we close any of these hourly bars above it? No, we can't. It fails. And the third time it fails, it's like, okay, that's enough. I've had enough. The market starts to move down. Where do we go down to? We go down to the bottom trend line right there, and the market finds support against that level, moves up to just above the 100-bar moving average here, and then says, okay, we've had enough. In fact, it comes back up to this remembered line here at the 158.20 level, and the market starts its descent to the downside here for the sterling versus U.S. dollar. You get a nice trend move to the downside. You get a corrective move to the upside. You draw your trend line. The market comes down to a new low. What do? You draw your trend line comes up to this line right here, and you anticipate the market is going to use that level as a level to sell against. Is that a low risk trading level to sell right at this point right here? Of course it is. It allows you to define your risk and move and to anticipate that the market might in fact go to the downside. And even if you're even this small move right here that looks relatively small, this goes from a high of 155.75 to a low of 154.79. I mean, that's about 100 pips to the downside by my calculations. But what is your risk on this trade? Your risk is something very little. So so put these lines in, folks. Put these lines in. They will give you good levels to trade against, good low risk trading opportunities that allow you to take advantage of the market movements, of trend type movements with a very low risk trading opportunity. The market breaks to the upside, come back up to there's this remembered line here, this old low right here. In fact, if you go back in time, I think you will see that over time this market had some levels at that 156.46 level, so the market did find some resistance against that level, and back down below we have a double bottom here, and now the market is consolidating as the day comes to a close. Key levels in the dollar versus yen. As a chart, we have a nice remembered line at the 84.40 level. We had a 40 high, we had a 38 high, we had a 35 high, we had a 30. I don't know. This is 38 high. We went up, broke through, went through 50, could not get any higher, moved down back lower. And so needless to say, 84.40 is going to be a key. 84.40 to 51 is going to be a key level, a key remembered line here for the dollar versus yen. If we're able to break above that level, look for momentum in the upside for the dollar versus yen. On the downside, we also have support against this 100-day moving average here in the dollar versus yen. Take a look at the hourly chart in the dollar versus yen. This may give us some clues for action here today. We have tops here, 1, 2, 3, 4, 5. We came right up to that, in the last hour, came right up to that top trend line at the 75 level. In this hour, we came right up to the top trend line at the 73 level. Current price is 70. If we break through this level, we need to see momentum to take, look for further momentum to the upside, look for a move to test the 200, the 100-bar moving average, and we could see this market break to the another trend line here. I'll try now. I'll come in here and put in lows here. Forms this wedge here. Which I think it's a elliptical formation. Regardless, one way or the other. I don't necessarily try to anticipate that a formation is going to move one way or the other. All I know is that I can define risk by 1, 2, 3 different points here, and if the market should break to the downside, they give me another clue that the market should have potential on a downward or upward direction. Dollar versus Swiss. There's a nice trend line here off of highs here. 1, 2, 3, 4, 5 different levels on the top side here for the dollar versus Swiss, provided nice trading opportunities for those people who are aware of that trend line with low risk trading opportunities. Here's a nice remembered line here coming across here that pretty much kept the market in its place. When the market started to come off of the lows, we have 1, 2, 3 different bottoms on the downside. That's an obvious remembered line that you can put in on the low. It's a little more obvious than something a remembered line that might be in the middle of a trend, like something like this line where the market used this level as a ceiling, broke through the level, used it as support, broke through the level as support, went through it again, came down, used it as support, and used it as a ceiling. This is what I term a remembered line. If the market should get above that 96.41 level, I think we should see the market move to the upside. These are all examples of the activity or the types of trend lines that you can draw in different charts and analyze the market from a very simplistic standpoint, looking for those opportunities to take advantage of the market. The final chart I want to look at is, and then we'll get to some questions, is the dollar versus Canada. This remembered line is actually a remembered line that I've had in this chart for quite some time, and for whatever reason, it always attracts some interest in the market, and that is the 102.05 level. And you can see over the last couple of days, we had a couple of reasons why this 102.05 level is a significant level just off the daily chart. I'm going to make this a little bigger right here. There's that there. But if you look at the dollar versus Canada, and you connect this high to this high right here, the trend line came in around the 102.03 level, and the market went up to 102.08 yesterday, and today we had the trend line come in around the 101.90 or 102.01 level, and the high came in at 102.06 and quickly moved off of that high. But I also have this as a remembered line, a line that goes horizontal across the daily chart. And the reason why I have that is I go all the way back in time, and I go back to this point right here of October 15, 2009, when the market was in a nice downtrend to the downside here for the dollar versus Canada, and the market went down to the 102.05 level, and then the market quickly moved back up to the upside. Oftentimes, remembered lines have characteristics of being lows that get quickly rejected. Those lows, when you have a rejection of a low or a high, I always look for that level when it gets revisited to find some support. And so in this case, the market went down all the way back in October 15, 2009 to the 102.05 level, and the market bounced off of this. On this day right here, the market came back down to the 102.05 level and bounced off again. So I automatically, at this point right here, I started to put this 102.05 level as a key remember line. When the market came down to 102.050, we get a bounce off that level. When it breaks through the level, we use the level as resistance, and the market moves to new lower levels. When we move above the line, and when we break through, the market starts to trade a little more volume around the level. But even in between this little move to the upside and move back to the downside, we found support at 102.05 level, and we broke to the downside, and we made another move to the downside. When we came back up, where did we go? Up, right toward that 102.05 level. It got to a high of 102.14, and the market moved back down. When we came back up, where did we go? 102.05. When the market broke through, we would zip into the upside. When we came back down, we'd use the level as a base to the upside, and it becomes a little bit more dicey in this situation with the market, but the market quickly, when it breaks the 102.05 level, quickly moves back above. And actually, these are opportunities where you can actually get back onto the trend to the upside. Notice the 102.05 level again. That level provides a level where the market finds some support. Now we get a little bit dicey in this area where the market figures out that we're going to trade this price a little bit more. And then we move to the downside. We find this support in the dollar versus Canada at the 99.82 to parity level on the floor. A number of different lows down there. Another key remember line. When the market quickly retraces back up to the upside, there's a reason for the market to take some profit at the 102.05 level, and that's what it did. So, we went through a lot of charts. We went through trend lines. We went through remembered lines. They're very simple, I think, but they're very effective. They help define bullish and bearish bias. They also help define your risk. So I will now take some questions if anyone has any questions, or if you want to take a look at some of the other charts, we can take a look at them, and we can look at it in terms of not only trend lines, but things like moving averages and Fibonacci retracements, what I think about the market as we head into the Christmas weekend here today.
Great question. The question is from Dr. Rob. He wants to know how many points should a trend line touch before it is considered a trend line?
That is a good question, but you need 2 points to make a trend line, and so that's the minimum. Okay, the minimum is 2 points to make a trend line. What I will try to do, as a doctor, is to even if I have, let's say I have these 2 points right here, and the market starts to move to the downside, I may put in this trend line as early as this point right here, and put a parallel trend line where I think the market, may like to go to. Now, it's doubtful that I put it in at this point right here, to be honest with you. But I'm constantly looking for channels in currencies, because I do think that the market likes to define the boundaries, the guardrails, if you will, for the longer trends and even the mini trends that occur in the currency market. So I'm not shy to say, in this quiet period here, to put a line in there off of those points, and then I'll look to see if there's anything that I can do as far as a channel trend line. And even when I get this high right here, and I have this clear channel defined on the bottom, I just put that in. I didn't realize it here. But the market comes up to a high, corrects lower, and where do we go? Where do we find that resistance? We find it against that top parallel trend line. So it only takes a couple to put a trend line in. The more you have, the better the trend line is. Why? Because the market realizes it. The market sees the 5 points along the line. It sees all this test right here. It knows that, well, we come down here, this is a good level to buy. And so the more you have, the better off you are. But sometimes even putting a parallel trend line against a top level here that kind of goes to nowhere on the top side can allow you to anticipate where the market may stall on the next time up. So don't be afraid to use them. They're very effective tools. Use them use them if it makes sense to you, if it looks good to you, if it's visual to you, and this channel is visual. This channel, even though the market breaks out of this channel, you can visually see this movement in here. Ignoring that, if you ignore this, you can see the flow of that channel right there, just like you can see the flow here. So, any other questions you have, Sean? I hope that answered that well for you.
got two concurrent levels, meaning maybe a 100 time frame moving average coming in right near a trend line. What do you do? What's your bias? Which one is more important in your opinion?
I interpreted your question right, Sean. You're saying that if I have a trend line or a moving average line coming together at the same point, which one has more importance? And quite frankly, if they are close together, if they're on top of each other, that's the best of all worlds. That's like having two trend lines, like we saw in the earlier example, a remembered line and a trend line coming in at the same area, like this area right here, where the market had a nice trend line. We had a nice remembered line right here at the floor level, and the market bounced off that level. So if you have a moving average line and you have a trend line, it's the same thing as having a remembered line and a trend line. They're two borderline levels. They're two levels that the market can see. So if this line right here, imagine our moving average line being down there instead of the trend line, it's the same rules for me. It gives me added confidence in that area as a level where the market is going to pay attention to, that the market is going to find support, or it's going to break through and it's going to trend in the direction to the downside. We don't really know what necessarily is going to happen at this level. All we know, the thing that I anticipate is that I don't know if it's necessarily going to go higher or lower. I may have a bias on whether it's going to go higher or lower. I just know something is going to happen, all right? Something is going to happen, and so I'm going to be on red alert, if you will, that an event is going, or a movement is going to happen in the market that's going to provide a profit opportunity for my trading, where I can define my risk at a small amount and allow myself to benefit from that small risk and the potential for a move, even in this modest trading day, that is significant, certainly to the trading range for the day. And if I know that, then you know what? I'm doing better than the next guy. I know that. And so it's a matter of me looking at the market, seeing what happens when the market comes down here, maybe putting my toe in the water. If I feel confident and I want to be a buyer of the euro versus US dollar against this level, I can just buy it right off the level and move and have the market move in my direction. A more conservative play would have it find support against here, and when the market moves above this trend line, then get in at that level, which is 131.42. The trend line comes in at 32. This level comes in at 30, and I'm risking 12 pips with the potential, that the market goes back up to the 85 or so level on the top side. It's still a multiple of the risk that I'm taking on the trade. So that's what you want to do as a trader, is be able to risk a little and potentially make a lot.
Great question. Should the trend line be drawn at the body or the wick of a candle? Because sometimes we see respective trend lines with wicks sticking out. And so, Greg, that's a good question, actually. What do you do when you're running a trend line across a number of points? Where do you put them?
That is a good question, and the way that I always do it to the bottom or the top of the wick. Okay, let's get that squared away first. Is that it goes from a low to a low to a low at the end of the wick. Now, if the market breaks through the wick, like Dr. Rob says, that oftentimes you'll get a market where the market moves through the wick, and instead of it going lower, it reverses and starts to move higher. Those happen. But those instances tell me something as well. Why? Folks, you are trading at a borderline, okay? It's bullish on one side, bearish on the other side. And assume that the market came down through this channel trend line right here, and instead of going lower like it did, it reversed and went higher. So someone would be, like Dr. Rob, would be selling on the break of this trend line right here. One of the things that you have to be aware of and prepared for as a trader is that the market doesn't do what it should do. And I call that my if should rule. And it's like if ... should rule. All right. And I have that on a note card right here, on my desk, and it's taped to my screen, and it says if ... should. And I don't even have to put rule, I'll just shorten it to if should rule. And the if should rule says if the market does X, it should do Y. If it doesn't, then get out. Okay? That's why you trade at borderline levels, is because it should do something at that trend line. It's a visual. Everyone can see it. If it doesn't do what it should do, like break the line and go lower, then get out. And it's as simple as that. So that's why trading at borderlines is so important, is because it limits your risk. It says, it keeps you in check. It checks your ego at the door, where you're going to say, gosh darn it, the market's going to go lower. Well, it didn't, Again, assume that in this case the market goes below that trend line, and instead of it moving lower like it should do, what it does is it moves back to the upside, and you lose on a trade. That's what happens in trading. You lose money and you make money. What you want to do is find those low-hanging, get those opportunities where it works your way, where you have good trade location, where the risk is really minimal. Once you hit a spot like this right here, and it holds that line, and you have good trade location right here, and the market starts to go down, even when it corrects up to this point right here, your stop is at your break-even point. You will not lose money on that trade. Is that a good situation to be in as a trader? Yes, you want to be in that situation where you have low risk, low opportunity. Now, if the market doesn't do what it should do, doctor, get out. Get out. It didn't do what you should do. Don't put your ego in front of what the market is telling you. Let the market decide whether you're going to be right or wrong.
Okay, great. That's a great answer, Greg. Now, I'm assuming that what Adrian wants to know is, he says we've been concentrating on the 1 hour and the daily time frame. He wants to know how you use the 5-minute time frame to enter. Maybe you can wrap that into how you would put a trend line on the 5-minute time frame, as I'm sure many people are wondering.
There we go. That's a great question, Adrian, and there are opportunities in the market on all different time frames, and it depends upon what kind of market you're in. But in something like this 5-minute chart, you can sit there and define these ranges here. The market is trading narrow. It breaks below the trend line. What do? You expect the market to go lower here. It's a narrow trading range. You sell the market on the break of the trend line, and the market, what does it do? It can't get below this low, can't get below this low, so the market moves up. What do? You get out of that trade. It didn't do what it should do. You exit out with a small loss. The market does the same thing again and moves down below the trend line, and you might even actually redefine the trend as this point right here. At this point, why? Because the market failed and the market came down to a new trend line. So now you have to get through that level. You get through this level, and you have to get through that. And what happens? It doesn't work. So the more the market consolidates like this, the more confident you are that, okay, well, something's going to happen. We'll see what happens here in the market. So even on a 5-minute chart, if you're just looking at this from an intraday perspective, we now have a new trend line coming in here, and this time when the market breaks the 113.56 level, you're more prepared to again anticipate a move to the downside. The market obliges and goes down to the 150.94 in a short order of time, and then uses this 30 level as support and then moves to the upside. So I guess I'm always looking at. I know I concentrated on the hourly and the daily chart today, more so because the 5-minute chart was pretty choppy activity. But I often will, and not often, I do look at all charts and look for clues in all charts that are going to give me ideas about what the key levels are. And off the 5-minute chart, I get the same view that the hourly chart gave me at this 30 level, 130 level. And you can see here that the market, when the market was down at this low levels, and the market moved above that 30 level, the market broke through that level. This is a key remembered line on my 5-minute chart, as it is on the hourly chart. There's no difference. It's the same price. And in fact, if I see a remembered line off an hourly chart or a 5-minute chart, I will. Sometimes you can see it clearer on the 5-minute chart. Why? Because you see more more levels. You can see the more detail in regard to where this low is, where this low is, where that low is, and stuff. And so you can refine your area where the support or resistance level is, and then I'll go and put it on the hourly chart, which may not necessarily show the same thing. So again, I'm just trying to put those lines in the charts that make sense to me from a technical perspective. I also incorporate other tools in my analysis, like these moving averages. This is the 100 bar and the 200 bar moving average. So not only do I have obviously this line over here at the 131.63 level was another key level here today. Look at the low, look at the low, look at the high, look at the high, look at the high, look at the high. But I also have this 100 bar moving average right here at the 131.63. And what happens when the market breaks 131.63? It moves sharply to the upside. So it's the same dance, okay? It's the same dance that you're dancing using all the charts. Use them in conjunction with each other. If you can find a clue off the 5-minute chart that's clearer versus the hourly chart, use it. If you can find, if the hourly chart is giving you a more broad view than this choppy action that we see in the 5-minute chart, use it. But oftentimes, if you use the tools like this is a 100 bar moving average, this is 200 bar moving average, this is the key remembered lines. You can draw these lines here. You can see the pattern that's developing. You can get the idea of, okay, where's the low hanging fruit today? How am I going to take advantage of it?
All right, thank you very much, Craig. It's 11:54. I'm not sure if you want to wrap it up at this point. There are no questions at this point, and I think it's been a great training so far.
All right, why don't we end it at that point? If there's no more questions, I appreciate everyone coming out here today. I want to once again thank the people at FX Street for providing this opportunity for all of you to come in and you're in here for a reason. Why? To get educated, to hopefully learn something, to have a different view as far as how to look at the market, how to approach the market in a way that will help allow you to profit more from the movements. Even on days like today, where we have choppy sessions, there are some clues out there that allow you to take advantage of certain lowers trading opportunities. So it's FX Street and the people there, thank you so much for all you do for myself and for the rest of the people out there. For those people celebrating the holidays over the next few days of this week, all the best for you and your family for a healthy and joyous holiday season. And to everyone out there, have a healthy and joyous New Year as well. We'll talk again in 2011 and look forward to it, having another great year. So God bless. Take care. We'll talk again in a few weeks. Bye-bye now.